To better understand financial risk management, it can be useful to relate the concepts to a real-life personal scenario. A young couple, Jack and Jill, both work full-time in well-paying jobs. They're getting married next year and have decided to purchase their first house. Interest rates are currently quite low at 5.5%, and based on their current salaries, Jack and Jill can borrow up to $700,000. They have also been saving for a few years and have $100,000 invested in a deposit savings account, earning an interest rate of 3.5%. Jack and Jill find their ideal home and purchase it for $700,000 and take out a 30-year mortgage for $630,000, which is 90% of the value of the house. Interest is variable and the monthly principal and interest repayments are currently $3,400. In the next year, Jack and Jill plan to get married and take a honeymoon to Europe for 6 weeks. They expect that they will need to borrow an additional $60,000 through a personal loan to pay for the wedding and part of the honeymoon. They have picked and booked a reception venue for the wedding, paying a deposit of $5,000. The $25,000 balance of the payment is due 2 weeks prior to the wedding. Jill also has several invoices for deposits for the photography, flowers, car hire and her wedding dress. These invoices contain clauses stating that if the deposit is not received when due, the booking may be cancelled. Having moved into the new house, Jack now drives 1 hour each way to work every day, travelling more than 900 kilometres every week and spending on average $150 per week on fuel. This is more than $7,000 every year. Now let's think about Jack and Jill's current circumstances. There are financial risks involved with many of the decisions that Jack and Jill have made or need to make. So we ask, what sorts of financial risks are Jack and Jill exposed to? Let's start with the new house and the accompanying mortgage. In this situation, there are 2 key financial risks that Jack and Jill are exposed to. One is whether they will always have sufficient cash to be able to meet the repayments on the loan. If interest rates rise too significantly, causing the minimum payments to increase, or if they have only one income source for a period of time, Jack and Jill may have difficulties in making the required repayments when they are due. It is also important to consider that in this case, a house is unlikely to be sold quickly for cash without significantly reducing the price compared to its perceived market value. And secondly, the mortgage loan has a variable interest rate, and changes in the interest rate will either increase or decrease the interest payable on the loan and the associated repayments. Having purchased the house prior to the wedding, Jack and Jill now have a significant mortgage and are considered to be fairly highly geared, with the loan worth 90% of the value of the house. To fund the wedding, Jack and Jill plan to take out an additional personal loan of $60,000. There is a financial risk here because the bank may not provide them with this funding due to the high mortgage owing compared to the value of their assets. And Jack and Jill have signed contracts and paid deposits for the wedding arrangements. For the honeymoon in Europe, Jack and Jill will need to make payments for accommodation and travel in euro, as well as having spending money. They don't know when the best time to book and pay for the travel will be to maximise the amount of euros that they will get. Also, for the spending money, they are unsure whether to convert Australian dollars to euro in Australia before they go or to buy euro when they arrive. There is therefore a financial risk here, as the Australian dollar cost of travel, as well as the amount of spending money that Jack and Jill will have, will vary because the exchange rates may change, with the value of the Australian dollar going up against the euro or down against the euro. Jill still has several quotations that she has received for deposits on the wedding: the photography, flowers, cars and her dress. In order to progress these and finalise the bookings, Jack and Jill need to pay the stipulated deposits by the due date. There are financial risks that arise here of an operational nature. If Jill forgets to make a payment, then she may lose a booking. If she makes the payment to an incorrect bank account or the wrong supplier, she may not get the money back, and she may also lose the booking with the preferred supplier. Jack and Jill paid a significant deposit on the wedding venue and will also pay the balance 2 weeks prior to the wedding. There is a risk here. If the venue, which is the counterparty to a contract, does not honour its commitments. Imagine where Jack and Jill would be if the venue closed down a week before the wedding and the owner disappeared, and they'd paid the hire amount in full. Jack is now purchasing around 100 litres of fuel each week for travelling to and from work. Therefore, this is an input into Jack's ability to earn income. Petrol prices in Australia can fluctuate widely based on the price of oil. Oil is a commodity product, and the price can be quite volatile depending on supply and demand. The oil price can therefore have a significant impact on Jack and Jill's day-to-day costs. As you would have noticed from this scenario, even in everyday life, there is a certain amount of exposure to a number of financial risks. These can have small through to quite large impacts on an individual's or a group's financial situation.